Important lesson today that I think is going to open some eyes. You have to trade your equity curve. For day traders who are trading like the E-mini or the NQs or the R2Ks, I get it. That is your equity curve. So I can understand how you can become emotionally attached to the outcome of a trade because that's a reflection of your equity curve. If you're trading overnight and you have multiple instruments in your portfolio, which in my opinion you should, then you don't have to live and die by any one particular trade. You can think of it like a basket. So for argument's sake, let's say that you have a basket, even 5 of the 8 or 9 names that are really driving NASDAQ these days. If you have equal proportional interests in those instruments, say, whatever, if you want to risk, say, 2% and at a clip across 5 names, so you'll have 0.4% allocated to each of those names on a portfolio heat basis, you can add risk with that basket and remove it all at the same time. So instead of having your emotional constitution invested in catching 4 points on the E-mini, which I don't even know why the hell you would do that. There can't be any fun in that. There's no money in it, and you have to spend way too much time. Do what you think is best, but what ends up happening is if you start thinking in a small-minded way, it's harder to break out to bigger levels, right? And I know you'll figure out step 2 when you're there, just like I will, on the new things that I'm initiating. But let's just say that you put 5 names on as your own little quasi-basket that you've created for yourself, and then you have a risk on, risk off. So you put all that money to work, you might find on any given day, you don't know which one it's going to be, but maybe 2 of the 5 really, especially when you look at the volatility that we see, these things are, up or down 2 or 3% at the open. So you might find like 2 or 3 of those names work strongly in your favor, right? The rest are flat to down a little bit. When you think about trading your equity curve, right, you're not emotionally invested in the outcome of any of those 5 to the extent that 1 or 2 of them really move and haul ass in your favor, right? Then, based on what your criteria would be, say it's 1% of your equity, as soon as you're plus 1% on your equity, guess what happens? You don't sell the winner and you don't puke out just the losers. You puke out the whole basket. When I've done back tests and studied, I've actually found that that's the best strategy. The problem is because of myopic thinking, I don't want to say micro thinking, I meant to say short-sightedness, myopic thinking, you become invested on the outcome of that trade. Now, that happens especially, and it's even worse, if you're focused on one instrument. And I'm not picking on day traders who trade indices. Yes, I am. It could happen with crude oil. It can happen with natural gas spreads. If you're just micromanaging that type of a deal, which admittedly is problematic if you're at a hedge fund and that's all you're trading, right, you're kind of stuck. So emotionally and spiritually, you have to pray and meditate to get away from that thinking, and that in some certain circumstances, if you don't have a flexible employment environment like I do, where you can mold yourself like a chameleon to fit and have an overlay that will work in a particular market environment that might be something in like January, but very, very different in July, August, right? Because you have to make money for your clients. You can put yourself into a funk because the market sucks for what it is that you're trying to do, right? So I understand that some folks have employment agreements that lock them into a certain type of a deal, and they can't really waver from that. So I concede that point. It's harder for you, but you still have to do the emotional and the spiritual work that it might take 2 to 6 weeks for the market funk to clean itself up in order for it to be amenable for your particular trading strategy, right? The rest of us, you can kind of change. And if you're a day trader, swing trader, you might want to think about thinking across many, many instruments as opposed to always just trying to snipe one particular name at a time. Now, that does take some back testing, but I think the big takeaway here and the big hint is that when you trade the basket or you have an equity curve, instead of looking at the chart of the instrument, look at the chart of your equity curve. Because when that goes parabolic, I can share with you, parabolas don't end very, very well, right? And you might stay at the party a little bit too long. So back test the strategies, and instead of using a stop on a per instrument basis, look at putting a stop on your portfolio equity, which would mean, yes, you can even piecemeal into the names, but then trade your equity curve, right? That's the pro tip of the day. Because at the end of the day, if you do that, you'll have more money at the end of the year. It might not feel natural because you want to let things go or wait for the stops to be hit to do this and that. But market momentum and how those things unfold, earnings, other economic data that come out that affect the tape the way it does, or they do, you might find that it does a lot. It has great benefit in smoothing your equity curve. There's a lot in that, so I'm not going to blather on it. Go back to back testing and take a look. Open your mind a little bit and add new names to your portfolio at the same time. Don't focus on one instrument. This way, you can still be diversified as a trader and take advantage of whatever momentum you're looking at across several instruments, because at that point, you don't necessarily care which one hits to the extent that one does. Then you puke out the whole portfolio, so you're biased long, risk on, then risk off on the whole group. You can still kind of day trade that basket. That's as much as I'm going to say on it. So if you have follow-up questions, I'm going to say go to a simulator, because that's really what you can do. You can't do it on looking at chart patterns. You have to keep track of your own equity, chart that in a spreadsheet, right? Maybe you can do it real time by inputting the data, looking at your account balance and kind of seeing. And then over time, you can see when you're on a good run, how much does your equity run up before there are pullbacks and short-term drawdowns, even if it's for a day, right? Because it applies to all different trading styles. At any rate, I appreciate you all being here. There's a lot of wisdom in what I said today. We'll talk a little bit more about trading strategies tomorrow and then take some time off for the weekend. Go get yourself your free copy of the audiobook version of Martin Chronicle. It's top right corner of the blog. And please like and subscribe. Leave comments if you'd like. I appreciate it, and I see everything. I'll see you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.